if you're ever thinking about starting a policy now, really, I've been in this career for 10 years now, and I haven't seen anything really close to as efficient as what policies are available to us as of a couple weeks ago versus really the last decade.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larson. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's episode, we welcome back Blake Brogran of Money Insights. We have a big announcement regarding one of our primary insurers that we work with for our investment optimizer strategy. Blake is a wealth strategist whose role primarily involves interacting with current and prospective clients of Money Insights. And he's been in the financial services industry for 10 years, working primarily with max overfunded life insurance strategies. And Blake and I are going to go into how I use these strategies. Some of our clients are utilizing these strategies, and how you can not only use these strategies as part of your investment flow, but also how you can create guaranteed generational wealth. Blake, great to see you again.
I'm back.
You are back. We're back. The country's back. Let's go, man. We are fired up here today, and we got a lot of optimism as we go into the end of the year. You know, the stock market's been up. There's a lot of economic optimism, but we're here to talk about some positive things that are happening in the life insurance space with some of the companies that we work with. Before we do that, we have a whole section on our website. If you want to learn more about some of the strategies that Blake and I are going to talk about today, please go to nextlevelincome.com, click on the banking link. That's nextlevelincome.com/banking. You can see a webinar that Blake and I have done talking about our core strategy, the investment optimizer. And before I kind of share some of the ways that, you know, my family uses these policies, Blake, and have used them for 15 years now, actually just passed my 15-year anniversary with our first two policies. Yeah. But if you would share a little bit about your background with the audience.
Yeah. So I grew up loving business. I was actually a caddy growing up, and, you know, got to caddy for a lot of business owners. So I was always interested in that kind of stuff. And when I went to college, I looked for one of the only schools in the country at the time that had an entrepreneurship degree. So it was Grove City College in Pennsylvania. This is back in 2009. They were one of the only schools that had entrepreneurship. Cool. Yeah. And I was just, you know, into learning about all type of things business. And it was actually one of my professors who ran e-commerce businesses who told me about these strategies back when I was, you know, probably 19, 20 years old, and how he's using insurance to fund his businesses and things like that. And so when I got out of college and started saving money, I set up some of these strategies for myself and became pretty passionate about it. And that's basically what I've been doing ever since.
No, it's actually amazing because, you know, I kind of learned the hard way, and a lot of people learn about these strategies. We're saying these strategies, what are these strategies? So I think a good quick overview would be valuable. Like, life insurance, and specifically traditional or whole life insurance, has become kind of like this taboo word, because people were taught, oh, buy term, invest the difference. Mm-hmm. And we've gotten away from traditional whole life that was really the standard about a century ago. And people like Ray Kroc, you know, the Rockefellers, you know, there's Disney, a lot of people that are household names today were helped buy life insurance for these things. And if you would share a little bit about what a traditional whole life insurance policy is, and then these, you know, max overfunded whole life policies that we're going to talk about today.
Yeah. So the traditional life insurance, you know, you've heard that term, buy term and invest the difference. So that's a pretty common kind of phrase, as Chris, you mentioned. So basically the idea there is that, hey, you need life insurance. If you were to pass away, you're raising a family, you know, so that things can be taken care of. Yeah. Term insurance is a much cheaper way to go than buying whole life insurance. So that's a thought. And I would actually tend to agree with that. Yeah. However, the type of insurance that we're talking about is not at all really focused on the death benefit. So yes, there is a death benefit, but we actually structure it to have the most amount of cash in the policy. So as you put money into a policy, we're designing it to build cash value as effectively as possible and minimize the death benefit. And then the key is and you'll talk about this with your story, I'm sure, but the money doesn't go into the insurance policy just to sit and grow, right? So a lot of the talking heads would be like, why would you put your money into insurance when it's going to get a 5% rate of return when you can invest in real estate or stocks that are going to get 7, 8, 9, 12, 30, whatever you're getting in your investments. So people who utilize these high cash value life insurance strategies are not putting it in just to let it sit and grow, but rather storing your cash in this policy as opposed to a bank account. And then when you're ready to invest, you can access the funds here to go do the exact same investing that you were already planning on doing. But we can go into some more of the details here, but you're actually able to capture all the return in the policy in addition to what you're doing on the investment side. So having it structured in the right way is really important. And part of why I'm jumping on here is to talk about some of the updates that the insurance companies have in relation to that.
Yeah, no, it's going to be great to kind of dive into the details there for those that are interested. But you said something important. So buy term, invest the difference. Term is like renting. So if you're
Yep.
listening, this is the first time you've heard about this strategy. What you can think about it as, it's very similar to real estate. So if you're familiar with real estate, you're familiar with a mortgage. Today, it's actually more affordable than ever, relatively speaking, to rent versus buying a home. Now, why would you buy a home? You build equity. And when you build equity in the home, the amount that you borrowed goes down over time as you pay that mortgage off. The mortgage payment stays the same, but the value goes down as that mortgage is amortized and you pay it off. But the value of the house goes up and it compounds on the value of the house. And this is what we show in our webinar on the website, which I encourage you to check out. And that compound effect and that difference or that arbitrage is what creates a very powerful formula to do this. And what Blake is talking about, what we specialize in doing for our clients, is we actually reverse what most agents do when they structure these policies. So instead of saying we're looking for $1 million policy, we build it around how much premium you want to put into the policy, which makes the policy more efficient, less costly, and it also maximizes and also grows the cash value much quicker. And when I learned about this, Blake, I was trying to figure out the best way to save for college for my boys. My older son will be 15, and I know it's been 15 years because since I had this policy, because I found out my wife was pregnant in October of that year. I took out policies for my wife and I, and it was with the intent of having a guaranteed amount of money available for my son. Now I have two sons, now sons when they hit college. And this is one thing that we don't say in the investment space. We don't say guarantees, but we can say guarantees in the life insurance world. So today, one of the big companies we work with, Penn Mutual, so they have a guaranteed rate. So when we structure these policies, Blake, maybe you can go into that. There's a guaranteed rate, and then there's also another amount that policyholders actually get. Can you talk about what that is and the nuances there?
Yeah. So when we talk about putting money into life insurance, roughly speaking, you're going to get about a 5% net tax-free return every year. So if you look at it like an investment, again, it's
Mhm.
more of a savings vehicle than an investment. But after all the
Yeah.
costs are involved with the death benefit and things
Mhm.
like that, every dollar you put in is going to earn right about 5% on a tax-free basis. How is it earning that? Well, the way the cash value grows is really there's two main components. There's a guarantee it's when you open up a policy, it's a contract insurance company, and there will be contractual guarantees in the policy. So just like you mentioned, the cash value can never go backwards. In fact, it's guaranteed to grow. So the guarantees with the companies range between 2 to 3.75% right now. Penn
Okay.
Mutual, most life insurance companies are at 3% on their guarantee. Now, on top of that, they also pay what are called dividends. So the reason that you get a dividend from this company each year is because it's what's called a mutual company, mutual life insurance company. And there's a handful of really good mutual life insurance, probably a dozen or two
Yeah.
out there. And what happens is in a mutual life insurance company, that it's actually run for the profitability of the policy holders themselves. So there's no shareholders in the company. So as a company
So
like
I
Penn
think that's
Mutual,
very
go
important.
ahead.
You said a mutual insurance company is actually effectively owned by the policyholders. It's run, it has to turn a profit, otherwise it wouldn't be in business. And how long has Penn Mutual, for instance, been around?
Yeah, so a bunch of companies have been around for a long time. Penn Mutual is pretty normal. They've been around since 1857 and they've paid a
Wow,
dividend every year since 1859. So,
incredible. Yeah,
170 years a row of paying these dividends. And the
yeah,
reason they do that, to your point, Chris, is because you're an owner of the company, the profits every year are distributed back to the policy holders in the
love that.
form of an annual dividend.
Yeah.
So the dividend portion is not necessarily guaranteed, but again, they've paid it for 170 years in a row and pretty safe to rely on.
Yeah. No, and I think that's an important facet of this because if you can't do this, like I called State Farm when I learned about this strategy, who I have my homeowner's policy, my car insurance with, I actually worked for State Farm. And I talked to the agent, explained it, and he said, sorry, we actually can't do that. We couldn't do that for you because we're not structured the right way. So it is very important that you work with the right company. And then it's also important that you choose the company based on your specific situation so you can maximize that cash value, right?
Yeah, for sure. So when we're sitting down with someone, we're looking at, okay, well, let me just use myself as an example.
Sure.
Any dollar that I'm eventually going to go put into any type of alternative investment, by that I just mean anything that's going to cash flow, I'm trying to get into my policies first before it then turns around and goes into the investment. Because when I get my money into the policy, yes, death benefit created, but more importantly, I'm building up my cash value in there. Every dollar that I put in there is guaranteed to compound in a tax-free manner for the rest of my life. And I have access and guarantees. And really, the key is I have liquidity over that money. So as soon as I fund it, within 30 days, that money is available to me and I can either withdraw the funds, but most typically what we do is you're able to take a loan against it. When you take that loan against it, if I have $100,000 in my cash value and I tell the insurance company, send me $100,000, they're actually sending me their money, their 100,000.
Yeah.
My money stays in the policy. So I go out and invest that $100,000. I get whatever return I was getting in the real estate or investments that I was doing, but I'm also getting that same 5% interest on the full 100,000 in my policy in addition to my return in the investment because I never had to take the money out of the policy. I'm just able to leverage it and create this arbitrage you talked about.
Yeah, and we show this in a graphic in our webinar because I think it's a little counterintuitive. So if you're a financial person, you understand compound interest. But remember the example I gave if you're listening. The example is you're paying down your mortgage at say a 5% rate, but if your home is appreciating at a 5% rate, your home is actually appreciating year over year faster than the amount you're paying because you're paying it down in a straight line fashion and your home is appreciating in an exponential fashion. So it's a very powerful strategy. But what you're talking about, Blake, is even more powerful. So let's say I can go and I have maybe let's say I'm a hard money lender and I'm lending my
Mm-hmm.
money to somebody at 12%, for instance. So I can borrow money against the cash value of my policy at say 5%, and I can lend it at 12%. I can earn that arbitrage of 7%, and then I can pay that loan back and do it all over again. And this is what I learned. So I get these policies set up. My wife and I start building spec homes and we borrow money. And I love what you said. We're actually not even taking the money out of our policy. We're using the cash value as collateral. And the insurance company wants their policyholders to do this because they need to earn money on the cash values that they have because they need to turn a profit every year. They invest in very safe assets, bonds, very safe real estate, loans, those sorts of things. What is more safe than loaning money to the owner of a policy where that policy is collateral? And I learned about this. And one of the amazing things is you can pay the loan back on whatever schedule you want. You don't even have to pay it back ever if you don't want to. And this might be counterintuitive to a lot of people, but the way I like to think of it is, and this is why people say a family bank or bank on yourself, this is the same strategy. When you own the policy, you actually become the bank. So if you're lending money, the bank, if a bank's lending money, now you're lending money, that loan is now an asset on your books. So if you own the asset on the books and you also have the liability where you repay it. It's effectively a wash. And this is where the strategy becomes so powerful.
Yeah. And even more specifically, if you have cash value in this policy,
Yeah.
the reason that they're happy to loan you that money, and yes, they're going to charge interest. However, they're not going to require that you pay because they have your asset sitting there. So, for example,
Yes.
if you said, "Hey, I want out of this deal," and you have a big loan outstanding, then subtract what you owe them
Mhm.
on the loan side, less whatever cash that they're sitting on that belongs to you. That's your equity
Yeah.
essentially in the policy. So they're always whole. And if you were to pass away, that money, they, because it's whole life insurance, they've made a contractual guarantee to pay your family a large sum of money. So they would just subtract it off that eventual death
Yeah.
benefit. So the insurance company loves this because they're whole. They take no risk by loaning their policyholder money. But what it allows us to do as investors is have total control over when we repay the loan, or really
Yes.
at the end of the day, even if we repay the loan, because
Yeah.
again, we control this asset, and so it makes everything flow very smoothly.
No, it's fantastic. It's as you said, it's the cornerstone of what we do, and we try to flow every dollar through our policies first. And you and I just talked about this about a month ago before I loaded up my policies here for the year, and then that money comes out and goes into investments if they're a good investment. Because if I'm
Mhm.
earning, this year, 5.75% was my net return. Um, Inside these policies, which is a good solid tax-free return. But I want to go back to what you said, Blake. I don't really think of these policies as investments. They are a tool. They are a vehicle that we use. And some of the reasons that I like it, that our clients like these policies, is because one, they are guaranteed. So they're guaranteed to grow at a specific rate. Two, our families are immediately protected. So the example you gave, if we have $1 million of cash value in a policy, we borrow that million out and something happens to me, a month later, a year later, and let's say a $5 million policy, the insurance company just takes that million, repays themselves, and the proceeds, the $4 million, would go to my family. So it's very flexible when it comes to that. My family's taken care of. These are also private contracts. So there's a lot of creditor protections. It depends on the state you're in, what
Mhm.
those protections can be, but they're private. There's creditor protections. There's a lot of advantages when it comes to that, and the flexibility is a big one. But also one of the things that I like is that for my children, I can essentially create a student loan program. They can borrow money. Now, people would say, well, Chris, why not just give them the money? Well, I want my children to understand the cost of capital because maybe they have a better use for that money. Maybe they can get a student loan at a cheaper rate, or maybe they get a scholarship. So, that's one thing to ask yourself. If you're out there, you have a Coverdale or a 529 plan, and you're maxing that out. What if your kids don't need that money for education? What if you could help them start a business, while they are, working on getting into college or while they're even in college? So there's a lot of cool things that you can do it. Anything you'd like to add to that?
Well, I mean, I agree with you fully. I've got four kids. I've got policies set up on each one of them. But to your point, one of the big reasons I like that is I control all the cards. So,
Yeah.
maybe they don't need it for college. Maybe they need it before college for whatever reason. Maybe they want to start a business with it. Maybe you want to
Yeah.
save it for a wedding or a down payment on a house or whatever the case may be. I own the policy. I control the cash value. And then if I want down the road after they're 18,
Yeah.
I can transfer ownership over to them if I feel like that's in our family's best interest,
Yeah.
or I can just keep it myself if they're going off the rails and I control it. So
Yeah.
it's nice to have total control over
Yeah.
what's happening with the asset.
Yeah, and this is kind of like an advanced strategy, if you will, but you can put the proceeds into a trust, and you can actually direct that trust to continue this strategy for your children, your grandchildren, and create guaranteed generational wealth in a guaranteed process. And I don't know any other strategy that you can do that you can essentially guarantee generational wealth. Do you? Are you a high income business owner or professional earning 300,000 or even more a year, but still feel like you're living paycheck to paycheck? Are you comfortable working until you're 65 or 70 to retire? Or do you want to achieve financial independence and live life on your own terms? You could join myself and Matt Ford and learn how we both became financially independent in our early 30s. We will teach you how to make, keep, and grow your money, teaching you strategies to maximize your earnings, keep your income that you've earned through tax strategy and legal structures, and ultimately teach you how to grow it by determining your personal investing strategy, as well as teach you how to analyze investments so you can grow your passive income to the point to live life on your own terms. Our coaching clients reliably do this in 7 years or less. To learn more, check out our coaching program at nextlevelincome.com/coaching. That's nextlevelincome.com/coaching.
No, and people refer to this as kind of the Rockefeller method. If you kind of Google that, then you'll see a bunch of stuff on that. But yeah, that's actually what's set up, is that as each generation, passes away, there's huge windfalls through these death benefits. If you direct that money to start new policies on the next generation, even if you really screw things up financially, but you have this guaranteed death benefit that's eventually going to pay out, your wealth will exponentially compound. Generations continue.
Yeah, it's frankly it's breathtaking when you look at the effect, because this isn't like, oh, we double it. You can 5x, 10x it generation to generation in a guaranteed fashion. But the generations can still have access to that cash value to go out and start businesses and do things. And I think that's very important. So if you're taking the time, if you're a frequent listener of the Next Level Income Show, you're teaching yourself about strategies to achieve financial independence. You can encourage your children to do this. And this is one of the cornerstones of what we do with this. Blake, I'd love for you to share what's the big update that we have today. And let's talk about some other ways that our clients are using these strategies before we wrap up.
Yep. So really the big update. So if we've mentioned Penn Mutual, a lot of people, let me even back up and say this. When we're evaluating policies as investors, what we're looking for is, for the capital that you're putting into the policies, which company and which policy designs are going to grow cash value the best. Yeah. And so that's where Penn Mutual has been a little bit ahead of the competition for the last decade plus or so. So a lot of people use that. Lafayette Life,
my policies with them.
Yeah. Lafayette Life would be another good company, or Mass Mutual, or things, that might be a company that you've heard of. But essentially what these insurance companies do, they give you the guarantee, plus they give you this dividend as well. So the dividend rate that you mentioned, 5.75, is what a lot of these companies have been at, Penn Mutual specifically, for the last 6 or 7 years. So keep in mind that was during, the 2020, 2021, when interest rates were very, very low, offering, 5.75% dividend. Well, the good news is that they have now announced that their dividend is going up to 6%. So every person who owns a policy with Penn Mutual, and frankly, most insurance companies are making a jump up this year if they last year. So all of the original projections that you were looking at, if you own one of these policies now, they're going to pretty significantly outperform what we were originally projecting at the time where the policy went into force. So now you get the guaranteed interest plus a larger dividend. And again, those dividends just compound on each other every year. So the big update for all policyholders, whether you're looking at an old policy or a new policy, they're going to have higher dividends, therefore higher cash value growth. The second big update I want to touch on here is that really insurance companies typically come out with new products every 2 to 4 years. So they're constantly competing with each other, trying to make more efficient policies that, yes, they can be profitable as a company, but they want to be able to attract more policy holders as well. So Penn Mutual had the same policy for the last couple of years. Well, they just said, hey, we're kind of going all in on this strategy of accumulating cash value in policies. We're already the leader, but we want to make these policies even better. So what they've done is, just as of October 1st, and I know, Chris, you sent out an email to your list, but they have new policies that just came out, probably about 2 months ago now. And what they've done is really just lowered the cost on the contribution. So there's always costs going into the policy, especially in the first couple of years. They've even lowered those costs even more. And they've made some tweaks on how you can design some of the riders and things like that to make it more significant. So if you're ever thinking about starting a policy now, really, I've been in this career for 10 years now, and I haven't seen anything really close to as efficient as what policies are available to us as of a couple weeks ago versus really the last decade.
No, I love it. And if you want to learn more about the strategy, again, check out our webinar, nextlevelincome.com/banking, or click on the banking link. You can watch a webinar where Blake and I detail kind of exactly how this strategy would work. And if you want to see how this would apply to your situation, feel free to reach out, Chris@nextlevelincome.com, Chris@nextlevelincome.com, and just say, I want to learn about the investment optimizer strategy, and we can coordinate a time with Blake and I. And we'll wrap up here, Blake. I mean, so again, I've detailed how I set out initially to utilize these policies as a savings vehicle for my children's college uh, uh, planning. Also, we've used these to fund spec homes that we built. So we would borrow money out, we'd build a spec home, we use that land as collateral. And this may be surprising to some, but the banks don't know that we have these loans out against our life insurance because these are private contracts. So I just call the life insurance company. I say, hey, I'm going to borrow $100,000, or I go online and I click a button, and within days or sometimes hours, depending on what you have set up, that money is in my account, and the bank says, great, you have this cash in your account. And there's no approval process. It's as simple as that. I know that other clients have used this for lending to start businesses or as collateral for businesses. We talked about utilizing them for cash flowing real estate and those sorts of things. Blake, what are some other stories that you have of clients and how they've utilized these policies?
Yeah, you've hit on a lot of them. I mean,
Yeah,
myself personally, just doing some private lending,
yeah,
anytime you say,
love
hey,
that.
I can get a much better rate than 5%.
Yeah,
Now's the time to, dump the money into this
yeah,
private lending deal. I'd say 90+% of our uh, policyholders are actively involved in some sort of syndications, right?
yeah,
So they're higher income earners.
yeah,
If you're investing in some of the deals that Next Level Income's putting out, or other type of cash flowing investments, once you kind of understand the math behind it, it really becomes a no-brainer to try to
yeah,
capture the dollars into the policy first before they go into those syndications. But to your point, the really cool part is there's no qualification purposes. When you need
yeah,
money, you're not saying, hey, Mr. Banker, look at all my financials. You're not saying, am I going to qualify for this? Basically,
yeah,
you're just saying, here's what bank account I want it deposited
yeah,
into. Yeah, I call it your 1 week money, right? So it's not necessarily as
yeah,
liquid as a bank account, but within a week, you'll
yeah.
have those funds. You can do whatever you want with it. And then also you control the repayment schedule back to the policy as well.
Yeah, and I think it's great for an emergency fund. So if you say, "Hey, I want to keep 6 months, a year, 2 years of expenses in an emergency fund," I was just working with my stepfather, and his investment advisor said, "Oh, we want him to have a year's worth of cash on hand." Well, it's nice to have this cash on hand, earning, like you said, 6% tax free in your policy, which you can access. I know we have other clients that we've worked together with, and they use this because their business needs collateral, or their business needs a certain amount of cash or collateral on hand. Sometimes hundreds of thousands of dollars or even millions of dollars, and they're able to utilize some of these strategies for that as well. You can do key man insurance. So
Mm-hmm.
if you and I start a business together, we can have these policies on each other. Now, why is there a reason, Blake, that if you have a business, would you want the business to fund these policies, or would you want to fund them personally? Like, are there any advantages to or against that?
Well, a lot of people will ask that question when they're getting it set up. Should I have my
Yeah,
business fund it? And typically
yeah,
the reason they're asking that is because they're saying, hey, can I get a deduction on the
yeah,
front end?
yeah. How great is that,
And
right? Yeah.
yeah, of course, if that was possible, and there are, I should say, there are ways to do it. It's
Okay.
almost never in your advantage to put the money in post tax. So, from a taxation standpoint, money typically goes into these policies post tax. All the growth you get is tax free. When you access the money, that's tax free. And when the death benefit passes along, that's income tax free as well. So, it's kind of like a Roth IRA from a
Yeah.
taxation standpoint. But
Great
in
way to put
terms
it.
of
Yeah.
owning it in a business, typically people will own it personally. You can lend it to your business. So there could be a reason to own it within the business. Really, it's where you're storing up the capital
Yeah.
before you go out and invest. Typically,
Yeah.
we'll use that entity, and most of the time, it's as you as an individual will be
Yeah.
owning the policy. But there's also ways to have like trust as beneficiaries,
Yeah.
and there's some advanced strategies
Yeah.
there. Most of the time, you're owning it as an individual, but you can then lend the money to a business.
Yeah, and that's another great point. So you can actually lend it, and then you can deduct that interest
Yeah,
and utilize that. Which is again, talk to your accountant when you look
yeah,
at these strategies. Everybody's situation is a little bit different, but if you want to learn more, I talk about in chapter 3 of my book, Your Opportunity Fund. We have it on the website at the banking link, nextlevelincome.com/banking. Check out the investment optimizer, or again, feel free to email me, Chris@nextlevelincome.com, and say I'd like to learn more about the investment optimizer strategy. And I'm always happy to hop on a call, little strategy session, explain exactly how I've used these strategies myself. And the light bulb really went off for me, Blake, about 10 years ago. And I was sitting there with our estate planning attorney, and he said, "Well, Chris, you and Jess, you need to take some things into consideration with the size of your estate." And he told me the number, and I said, "Wait a minute, like that's not our net worth." And I was a little confused. And he pointed to my life insurance. He said, "You have whole life insurance. This is permanent life insurance. That's part of your estate. That's part of your net worth when you die." And I never thought of it that way. So if you think about insurance as something that's temporary, that's just for you, what I encourage you to do is think about it like you said, Blake, like the Rockefellers. If you think generationally, this actually becomes part of your family's net worth. And it's a very powerful force multiplier. And if you utilize it in the way that we've been talking about today, it's not either or, it's and. You can actually do
Mhm.
both. You can do this strategy and you can continue to invest. And effectively, these policies will pay for themselves. And what Blake and I do is we set up these policies so you're not stuck paying into them till you're 100 years old.
Mhm.
You can actually have a period where you pay for, I don't know, what's a common period that you see set up for these?
So as we start conversation, a lot of times we'll start with, hey, what does it look like if you fund this for 7 years and then
Yeah,
never after that? But
yeah,
because of how, in typical, if I should go back and say, typical permanent life insurance, you're paying into till you're basically dead, right? So if you
yeah,
have
like
a
like a
grandpa,
mortgage, like 30 years or
yeah.
so.
If you have a grandparent or a parent who's like,
Yeah,
man, I'm stuck in this policy and the premiums are going up and things like that, that's not at all what we're talking about. We put in
yeah,
way more money than we need to for the insurance portion
yeah,
up front. So the insurance costs are very low relative to a typical type of structure. But when
yeah.
you do it that way, we can get policies fully funded within 3 or 4 years. So you
Wow.
could fund this thing for 3 years,
Yeah,
never fund it again, get all the benefits that we're talking about. That being said, once you start to see what's happening after year 3, I'm putting in $1 and I get $1.25 immediately available, and I can go out and borrow against that and go invest, and those numbers just continue to compound
yeah.
over time. Oftentimes people want to keep putting money in, but yeah, you're not at all on the hook for a very long period of time.
This in your grandfather's insurance strategy. So, yeah. So, if you want to learn more, again, nextlevelincome.com/banking, feel free to reach out to me. Blake, I know you got to run. Thanks so much for sharing some updates and some of the ways that we've seen our clients utilize these strategies and these policies to help expand their family's wealth. Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.